Welcome and thank you for joining today's webinar, CPACE in Opportunity Zones. I'm Graham Richard and I will be moderating our session today. I'm excited about the clean economy investment potential in opportunity zones based on my own experience as a clean economy entrepreneur and as a mayor. Today's webinar is a collaboration between KPMG, a multinational tax and accounting advisory firm, and CleanFund, a leading national provider of commercial PACE financing. CleanFund is based in the San Francisco Bay Area, but works in active commercial PACE jurisdictions across the country. They provide an innovative financing solution that makes it easy and affordable for property owners to make investments in energy efficiency, water conservation, and other resiliency-driven building improvements. And here we have the traditional disclaimer. We look now to talk about the agenda. Our agenda today will include a brief outline of our intended outcomes, an overview of qualified opportunity zone tax benefits by Orla O'Connor, and then the third issue will be CleanFund opportunity zone funding and example projects with Wolsey McKernan, and then we will talk about the capital stack implications, Brad Wood, and we also are delighted to have a developer perspective from Tony Sherman. We will also take your questions and look forward to making available to all of you the audio recording and the slides after we conclude our session today. And so today we would hope that in our time together we could share opportunity zone tax benefits, an update on that, CPACE financing benefits. We also look to have an outcome of sharing financing synergies and the added value that CPACE could have in opportunity zones, and the capital stack analysis of project economics, and then of course some sponsor developers' perspective on the CPACE in opportunity zones. Our presenters are listed here. We'll be introducing each of them as their section comes to the fore. The first person will be sharing with us is the overview of QOZ tax benefit, Orla O'Connor. And Orla is a principal at the national leader of the practice for KPMG. Orla?
Good morning. Thank you for that. Just again, on brief intro, I'm really proud to be part of KPMG's National Qualified Opportunity Zone practice, and that we've been taking a very strong leadership position in this area, really investing heavily in the program and working with a number of clients and other stakeholders throughout the community in the Bay Area and nationally. So really happy to be here today. My job is to succinctly describe the tax benefits and requirements of this program with respect to real estate projects. That's a really difficult task because we could have a multi-hour webinar just on that component, but we have other important topics to address as well. So just to kind of set the stage in terms of where we are with this process, I think everyone knows that this was part of the broader tax reform package that was enacted at the end of 2017. It's a little bit of a sleeper in tax reform and didn't get a lot of early focus because people thought that this would be more of a regulated program similar to the New Markets Tax Credit Program. And it wasn't until around April that the IRS released FAQs providing that, in fact, this program would be self-certified by taxpayers. You just check a box on your tax return. So it's that really opened the floodgates to people seeing the potential and the broad application of the program. Then we had the process, the competitive application process by state governments, by which we had census tracts designated to be qualified opportunity zones. That list was finalized in the summer. We had some guidance released in the fall, which again stimulated some activity, especially people who had gains to roll over into the program who were anxious to get their dollars into qualified opportunity funds. So there was a big flurry of activity toward the end of the year around that. But where we are today is we're expecting both finalization of that initial proposed regulations package and a second reg package that would address a whole broad range of issues, operational issues for funds, and we expect there'll be another flurry of activity when those are released. Obviously, with the government shutdown, the timeline's been delayed out a little bit. There was originally a public hearing scheduled for January 10th on the first set of regulations that now has just been rescheduled to Valentine's Day. So hopefully that first reg package will get finalized after the hearing at some point this spring. And then the second reg package could be released, potentially could be released before even the hearing on the first set, but we're expecting that to be released sometime in February. And I should also just mention that there's been a lot of commentary on the regulations from industry groups. Most recently, I think there was a letter last week released by Congress, which is quite unusual, to the Treasury asking for some liberal rules to be implemented as part of the future guidance. So we're all on the edge of our seats waiting to see what that looks like. So moving on to the next slide, just high-level overview of the potential benefits of the program. I think everyone who's dialing in is aware of the very, very powerful tax benefits that are attached to this program. So just to level set, as a gating item, a taxpayer must have capital gains that they are rolling over into a qualified opportunity fund in order to, that's like a gating item, just to gain entry to the program and get the whole host of benefits. And then the three benefits that you get are, you get deferral of those gains that are rolled over, and that deferral ends at the end of 2026, so it's a temporary benefit. And when you pick up those gains in 2026, they retain the character of the original capital gain that was rolled over. So that's temporary benefit. To the extent you make your investments this year, there's a potential 15% forgiveness on those gains that are rolled over. And if you invest before the end of 2021, that benefit goes down to 10%, but there's still a forgiveness benefit with respect to the initial gains. But then what's really powerful, and where we think that people are getting really excited about the program, is the investment that's made in the fund, the new investment. You get a step up to fair market value when you exit your fund interest, and that basically means that your capital gain on the new investment could be permanently excluded from the tax base. And that's what people are really excited about, what we're trying to achieve. So this is just a quick level set in terms of the structure that we expect to be used most commonly. So just, you see at the top, the investors rolling over gains into the qualified opportunity fund at the top, but then the qualified opportunity fund most likely would make an investment in a qualified opportunity zone business down below. That's where we think the real estate development activity would occur at the lower tier, and the partner at that level could be the developer or operating partner. So just going next to the program requirements, couple things to highlight. And actually, I don't think we mentioned this on the earlier slide, but to get the third tax benefit, the permanent exclusion, there's a 10-year holding period requirement. That's a very key requirement that was highlighted on the earlier slide. And then on this slide, I want to call your attention to two things. So we said there's a gating item of having gains to roll over into the qualified opportunity fund. The other absolute must-have is you have to have qualified opportunity zone business property. So in the context of the upper tier, lower tier, we think that it'll be a 70% requirement, where you look at the lower tier real estate development project entity, 70% of the tangible property would have to meet the definition of qualified opportunity zone business property. We'll talk in a minute about what that looks like. But the other key requirement to highlight on this slide is you have to have not only 70% of your property meet that definition, but you also can't have more than, you can't have a significant amount of non-qualified financial property. This is the less than 5% test that's in here. And what's important about that is, obviously there's a huge push to roll over gains into these structures. But if you roll over $100 million in gain and then that cash is sitting idle, you could fail this test. So one really helpful piece of guidance that was part of the package in the fall was this working capital safe harbor that basically gives you 31 months to deploy your cash toward a development project, provided you have a written plan that sets out some details of how that cash will be spent. And so that's a really helpful piece of guidance, but there are some limitations around what's included and not included, and we can get into that later in Q&A if people are interested. So then just to round out the level set on the tax requirements, if we flip to the next slide, what is qualified opportunity zone business property? And this is really the core thing that you need to think through if you think you have a real estate project that could qualify for benefits here. You have to have tangible property acquired by purchase after 2017 from an unrelated party. So unpacking that, there are lots of people who already held real estate within qualified opportunity zones who are wondering how they can benefit from this program. It is theoretically possible. You just have to navigate this first requirement. So either you would lease that land into a new fund structure, or you could sell into a fund structure, but you have to make sure you meet this unrelated party requirement, which is basically 20% ownership test between the seller and the acquirer. And then secondly, you have to meet this original use test, which has two prongs to it. Either the property has to be originally used within the zone. So we need guidance on what that means. But if you think about ground up development, say you acquired raw land, we would think that the new building you're building would qualify for the original use test, but a lot of comments on what that should look like and what the parameters of that might be. And then the second prong is the property needs to be alternative to original use. The property would be substantially improved, which I think people understand broadly to mean you double the basis of the property. So there was a piece of guidance in the fall revenue procedure that very helpfully set out a fact pattern of you acquire land with a building on it. And it said for purposes of meeting this test, you really have to just double the basis of the building and you can ignore the land. This leaves a lot of unanswered questions about what happens if you're actually just acquiring the raw land. And again, we can get into that in more detail if people are interested. But looking at that construct, if you acquire a building and you're going to double your basis in the building, what's really important from a technical perspective is make sure that all of your expenditures actually would qualify as additions to basis with respect to the property. And we can talk more about how some of the solar and other energy efficiency improvements that you would be funding using your PACE financing might qualify. But the language is fairly broad, additions to basis with respect to the property. So our view, at least, is that you would not need to necessarily capitalize all of those expenses into the building as such, but you would definitely need to capitalize them into property. So for example, financing fees that get capitalized into the loan wouldn't qualify. And obviously anything that's a deductible expenditure wouldn't qualify. We can talk more about that later, but this was just a general level set to make sure we're all on the same page about the basic program requirements.
Thank you very much, Orla. We appreciate those introductory comments. Now we're going to turn to the CleanFund qualified opportunities on examples, and we're going to be introducing Wolsey McKernan, Senior Vice President and Chief Revenue Officer of CleanFund. As the SVP here at CleanFund, he's been responsible for driving sales growth, marketing execution, and product excellence across the company. Wolsey has extensive background in global real estate industry, including development, construction, structured finance, technology, and energy efficiency. Thank you, Wolsey.
Oh, that's a mouthful. Thank you, Graham. And thank you, Orla. We know QOZs are real and KPMG includes it in someone's title. Congratulations. So a bit about CleanFund to start. CleanFund is a leading nationwide provider of CPACE based here in Sausalito, California, a small town across the Golden Gate. The company has been at the center of the growth of commercial PACE industry, founded back in 2009. We did our first deal with a national REIT, Prologis, the largest industrial developer and owner. We broke our own record for the largest PACE deal in 2015, 2016, and 2017. And we've completed the industry's first public securitization with some of the world's largest insurers buying our bonds. We've got over $1 billion in capital commitments, and we're supported by two of the top mortgage originators in the country. So hopefully PACE is a bit of old news for many of you listening, but just in case it's new news, commercial PACE is a relatively new financing mechanism that offers long-term fixed rate financing with no guarantees. And it's really at its foundation based on 100-year-old bond finance, which is used to invest in the public good broadly. So think roads, schools, undergrounding power lines, and the like. But PACE is a voluntary tax assessment in support of, in this case, investment in private property. So it's secured, the lien is secured by a parcel tax assessment, which shows up on one's property tax bill, and it remains with the property and transfers on sale, which is unlike traditional debt, of course. Legislation's been passed in 35 states and DC, 20 of which have a live program and are able to fund transactions. So shifting the next slide, thinking about what's eligible, PACE, CPACE, commercial PACE finances up to 100% of hard and soft costs, focused predominantly on building resiliency. So smart investment in buildings around HVAC, thermal, new doors and windows, glazing, water conservation, or renewables, predominantly solar. And the property types of leverage PACE include, certainly the 4 food groups, but we've also done projects on a number of alternative asset classes, golf courses, storage, nonprofits, and the like. Old buildings and retrofits have been the sweet spot and really where the need for PACE originated, but also more recently new construction, which has enabled owners to lean on PACE to achieve higher levels of building performance. So a quick look at a case study. CleanFund completed the largest project to date in Texas at $24 million. The historic Butler building was an adaptive reuse of a downtown core office building a few blocks from City Hall and a conversion into a mixed-use facility with a hotel and a number of apartments. The client, Altera, came to CleanFund looking for an alternative capital source to complete the project. We were able to parse the budget and come up with a number of CPACE eligible items that matched the amount that they needed. And looking at what they needed, let's take a quick look at the capital stack as a precursor to Brad Wood's section. Not overly complicated. The senior was EB5 with some historic tax credits. 15% of the stack was high octane mezz that had termed in which they needed to replace to complete the project. So CleanFund layered in 6% approximately PACE, which resulted in a significant delta and ultimately highly accretive to ownership. And got a nice quote there from Mike, the principal, who's the CEO. So coming to my last slide, really talking about the alignment between qualified opportunity zones and CPACE, I think foundationally each is really based on supporting the public good. The intent is focused on direct investment into communities and projects that need resilient investment, ones that create sustainable jobs in real estate that is smart and intelligent, both saving energy or creating energy in the case of solar, but also delivering higher returns to developers and investors. So when you look at PACE, commercial PACE and opportunity zones, coupled up with opportunity zone equity funds, ultimately it's more cost effective than traditional forms of finance with a low, let's say 6% fixed rate in terms of up to 30 years without any guarantees on ownership. PACE is limited generally to 20 to 30% of the stack broadly. So I think by many measures, we're entering the end of our current real estate boom. And if you think about investment in opportunity zones and PACE as filling the gap and meeting the needs of construction budgets that have been pressured for a number of years, we're going to continue together the upgrade of America's built environment. So let me shift it back over to you.
Thanks, Wolsey. Appreciate that. We're now going to talk about capital stack implications. And we're delighted to have Brad Wood, another great leader from KPMG. He's the Managing Director for Economic and Valuation Services. Brad heads up the group that does a lot of the EVS practice servicing with financial services clients where asset management needs, where they have asset management needs and are focusing primarily on real estate. So Brad, we appreciate your joining us.
Great. Well, thank you, Graham. And first, I wanted to just add on to what Wolsey had mentioned about the program and the alignment with PACE, and that the program, the initiative is really about, providing capital in these underserved areas and 8,700 zones across the U.S. that are looking for capital to fuel development. Really, it's about prosperity long-term and creating the businesses and clustering within these areas. And what we see a lot of the time with observations so far is the early plays are kind of the real estate development, these shovel-ready projects that would have been developed already. But really, long-term, you want to see more green development, more than likely, especially as tenant demand as it comes into the zones and these clustering businesses are created. That's going to go hand in hand with PACE financing. But with that, I'll turn it right into the looking at the capital stack implications. And what we'll do really is comparative analysis in measuring kind of your standard stack relative to with PACE financing, and then also what's PACE financing look like as far as returns with a property that's in the zone. One thing I think it's important to highlight, what we expect here typically for properties in the opportunity zones, fueled by these capital gains, is you're going to have more than likely a higher equity component There's a few reasons for that. A lot of times the funds are going to be structured as single asset, and they're going to have this 90% asset test requirement. So that's one of the reasons, but as we'll see as we measure this further on in the slides, but you'll see that impact by having a higher equity component. And even the traditional senior debt may not be as interested in opportunity zones, especially initially, as these are historically underserved areas. There may be a little more risk associated with that, and then also they're going to be competing against funds that are really capital gain fueled. This capital stack we're going to look at, you got 10, 70, 20 here. So really 80-20 as far as equity relative to debt. And we'll look at some of the benefits you have, with PACE, 20% more long-term debt that's tied to improvements. So you really have collateralized debt, which is obviously very different than kind of your senior and non-collateralized. Also non-recourse, it's fixed rate. Those are some of the other benefits. It's important to note here, you see on the bottom that your return on equity certainly needs to be north of your return on equity should be north of what the PACE rate is for this to pencil. But we'll go on to the next slide and we'll measure here how the higher pre-tax IRR basis, and we'll also talk a little bit about after-tax as we think about gains. So looking at this slide, on the left we have some of our underlying assumptions. We want to keep these even throughout each one of these three scenarios to be sure we have a true comparison. And we'll start with that, and then we'll go into kind of some of the visuals. So you have a senior level debt we have here at 9%. Again, that's going to play into your standard stack. A PACE debt rate of 6%, typically going to be between 5 and 7. Again, a lower debt rate, longer term, and also you have it more or less collateralized with improvements. Opportunity fund will put it a kind of a standard 10% for that equity component, and then we have a few other inputs there. For operating assumptions, a couple of things to highlight here on these, some more than others. The exit year is important to note. With a 10-year exit, with properties that are within the zone, certainly going to maximize benefits by having that 10-year hold to realize that third benefit of the upside in value creation and appreciation. But also a 10-year hold, kind of your standard investment property, maybe not be so for a development property, but it is, again, keeping even with each one of the scenarios. An exit cap is 7. I guess that's a fairly modest number. We could very much argue that it could be lower, and that will have impact clearly to the bottom line as far on an IRR basis. And then our project here is a simple analysis. It's a ground-up development. We're acquiring the site for $10 million. We're going to develop it with a construction cost at $40 million. So we're all in at $50 million, and between land and improvements. The PACE savings rate is really the kind of effect NOI, an upward impact on NOI, because you're essentially saving $20,000 per year. Again, a simple input here within the cash flows. So moving to the graphic, left to right, the traditional capital stack on the left shows the higher investment. Excuse me, the higher initial equity investment from the owner, and then the debt, your standard 16-year rate debt layered in. So you'll see the bottom line here, 12.84 as far as return to the owner. And again, your standard traditional stack. And then moving into the middle section, you've got introducing your standard stack with PACE. And so you have a higher debt component, your 68% equity, your 32% remaining to debt. That's 20% of that. 20% is PACE financed, 6% clip. And the rest, again, that senior level debt. And you see the impact that PACE has on those IRRs, both to the investor and to the owner developer. And then moving on to the third one, and this is really showing the power of combining PACE with a property that sits within the zone that is going to bring in that equity, again, capital gain fueled equity within the fund coming into these sites. And you see an 80-20 split in that case, and then 20 being purely PACE. And then obviously with a lower 6% rate, that's going to have a huge impact. And again, you see the bottom line there. You see the IRR, again, on a pre-tax basis. So the owner equity is going up anywhere from 200 to 300 basis points. I mentioned before the exit cap is highly sensitive to this. There's a few other inputs that are too, but for the most part, the exit is important because that's when in a development property, you truly realize your returns. upon a sale. You'll see that you get 200 to 300 basis points differential between kind of your traditional and then compared to a PACE development within an operating zone. Now, this isn't factoring in, and we don't show it here on the slides, but it's not factoring in the after-tax component that would go to the investor or the fund. And that's certainly an additional element. Very complex to calculate that. It's going to obviously vary substantially from project to project. But if you do have a 10-year hold, what we are hearing in the marketplace is anywhere from another 250 to 400 basis points that'll be tacked onto that, again, on an after-tax IRR basis. So all in all, obviously CPACE, showing this here by this analysis, combining CPACE financing, optimizes the capital stack for the owner developer in particular. And then subsequent to that, the after-tax IRR is a true benefit by having a property within the zone for your investor. So with that, I'll turn it back over to you, Graham.
Thank you so much, Brad. We appreciate that. We're now going to have a developer perspective. We're delighted to have Tony Sherman joining us from Colorado. Tony is the founder and principal of Terrapin Investments and Management. He's considering a CPACE investment in a qualified ozone in Colorado, and he's had extensive hotel ownership, development, and management business experience since 2003, where he has run the management and operations of over 25 hospitality properties across the country as the founder and principal of Terrapin Investments. Tony Sherman.
Thanks a lot. Glad to be part of this. I think CPACE is a great tool. I think opportunity zones are an amazing piece of legislation. And when you can do them both on a project, then you really turbocharge your returns and your after-tax returns. You know, you can kind of see I'm in the hotel business. I own and operate hotels around the country. I'm a developer. I also build self-storage. I'm building one of those right now in California. I'd actually spoken with CPACE about financing the solar portion of it, which they were willing to do. Then our existing lender said they would do it at a very good rate, and it was kind of simple. But I'm dying to use CPACE, and I think this project I'm going to tell you about in Colorado is a perfect candidate. I own 2 hotels in Glenwood Springs, Colorado. You see the yellow box is a piece of land I want to buy. And you see right above the box, there's a Hampton Inn. I own that. And there's also a Holiday Inn Express that I own right next door. And then there's this parcel that I'm trying to buy. It's owned by CenturyLink, which is a telecom company. Move real slow, but I'm working on buying it. And if they're smart, they'll sell it to me because I'm the most logical buyer. What I'd like to do is put a Home2 Suites on the site, which is a Hilton brand. It's an extended stay property, and I don't think it would compete too much with my existing properties, and the market's very, very strong there. So I want to build it. Now, it's really coincidental that Glenwood Springs happens to be in an opportunity zone. There are some opportunity zones around the country, like Las Vegas, that I'm targeting for deals. This, I'm just lucky that it happens to be an opportunity zone. And the way I see it is an opportunity zone makes a good deal better. And from my perspective as a developer, I'm not going to buy something in an opportunity zone just because there are some tax benefits. To me, at least, I want to make sure that's going to be a profitable investment. If it happens to be an opportunity zone, that makes it even better for 2 main reasons. One, it'll make it easier for me to raise equity from investors because I think, you know, there's all this opportunity zone money out there, and I know a lot of people with huge capital gains that are dying to put it into a deal of mine so they can benefit from this. And it's just great because if you hold it for 7 or 10 years and you make money, you don't pay tax. So it's pretty awesome in a lot of ways. Now, CPACE, I think, is always a smart thing to do if your lender will let you do it, assuming you have a lender. But most people, most real estate investors, always buy with debt. Not every lender, I think, at this point is familiar with CPACE, but the ones that are and will allow it, I think it makes sense just about every single time. I really think using CPACE is a no-brainer. Now, it works best when a project is new. If you happen to own a property and have a fixed-rate loan, a lot of times those lenders aren't going to let you put CPACE on. So you really need to look at it, I think, when you're buying something and when you're going to develop. So here is my simple development model for this property. I'm hoping to buy it for $2 million. If you start on the top left, I think the site can hold 113 rooms, and all the numbers add up to an investment per room of $142,000. If you move far to the right and look at capitalization, it shows where the total cost comes from. It's about $85,000 in hard costs per key. It's about $20,000 a room for furniture, fixtures, equipment, sinks, sofas, beds, whatnot. Architectural, MEP is electrical engineering, consulting, an interest reserve, another reserve, a loan fee, franchise costs, closing costs, organizational, then a reserve. So it's about $14 million plus the land. So if you go up to the middle equity breakdown, the total investment is going to be a little over $16 million. You get your $142,000 a key. So if I was going to go out and get a construction loan, I could probably get a loan of 60 to 65%. And developers and investors in general want to get more leverage rather than less. Now, getting 95% leverage can sometimes be crazy and you can't get it, but anywhere from 50 to 80% is kind of the real world. And when you're building a commercial project, you're generally going to have to put down 30 to 40%. So in this deal, I'm sure I could get a construction loan for $10 million for, which means that I need to raise from myself and my partners $5.6 million, which is a lot of money. For some people, that's one phone call. For me, it might be 10 or 20 phone calls. So moving down, the financials, the first year, this is a very simple model. Say you can build it in 12 months. It's probably more like 18 months. The second year, we're going to be ramping up. We're going to have some cash flow, and the return on equity is a cash yield of 7.24%. The next year, if things go according to plan, it really jumps up 23% cash on cash. And let's say we sell it in the fourth year, and let's say that my numbers are accurate here. We have an NOI of a little over $2 million. We sell it at a 9 cap. Now I'm looking at the bottom right. And we might get a little over 200,000 a room. So that'd be almost 23 million. We're going to have to pay the broker. We have net proceeds of 22.5 million, pay back the lender, return the capital. And if things go well here, we've made a profit of almost 6.5 million, which is 115% of the original investment. And the IRR over 4 years is 30. Now that's phenomenal. And if I showed this to someone and they trusted me, which I think my partners do, and it worked out according to plan, we'd have a terrific return. However, the return would be even better if we use CPACE. So let's go to the next slide. So everything is the same here, except in the middle, I've highlighted PACE finance of 15%. And we're going to pay PACE a 6% rate. I think it's a 30-year amortization. Then to the right, in the capitalization, there's another fee. There's a PACE fee. It costs about 5%, I believe, in cost. So my total capitalization has gone up just by the PACE fee, $150,000, which is insignificant on a deal this size. What's very significant is instead of having to raise $5.5 million, now I only have to raise $3.2 million. Just a lot easier to raise less money, and maybe I'd put it all in myself. Maybe I have that much money. Maybe I can have a bigger share of my own deal because less equity is required. And then when you go back down to the bottom right, you see where it really supercharges your return. And if you go to the bottom right, since you have less equity and more debt, your return on equity, instead of being 100% profit, is closer to 200% profit. So on a $3.5 or $3.3 million investment, things work out, you can make a profit of $6.3 million, and that's an IRR of 39 as opposed to 29. So it's interesting watching the gentleman before me showing in his model that using PACE makes the return 300 basis points higher. In my model, it's like 1,000 basis points higher. So that pretty much concludes what I want to say, but I think the math is pretty straightforward, and I really like PACE and look forward to using it here and on lots of my future deals with CleanFund.
Tony, thank you so much. We appreciate that. And in order to make sure we have time for some questions, I'm going to cover the summary here briefly and then turn to some questions that have come in, particularly for Orla and Brad. What we can see, of course, is that as a wrap up, that PACE funding matches the intent of the opportunity zones. The public good investment, it's geared toward renewable or clean energy investments, all kinds of improvements in the built environment that could produce cost savings and reduce carbon pollution, for example. It's a semi-urban and suburban focus. There are actually some rural opportunity zones as well in my home state of Indiana and other locations. It's a long-term investment and long-term resilience investment opportunity. I see this as a win-win-win where there's a public benefit, there's a clean energy or a clean economy benefit to communities, and of course there's a private return. So a couple of questions have come in, but here's one, Orla, for you, if we might. When thinking about pulling out the cash and distributions, the refinancing that we've talked about, what do you expect the regulations to say regarding that 10-year holding period? I know it's hard to predict, but we do have projects that are moving forward, and we're interested in that. And then what about taking out operating distributions or refinancing distributions? What do you think might be the direction there?
Yeah, sure. So we don't have guidance on this specific topic yet, but we expect that it will come because it's been a big topic that a lot of comment letters have focused on. What I would say is this. There is a concept, at least within the tax community, of there being your normal tax basis rules where you can always pull out cash as long as you get outside partnership basis for your debt. And those rules remain in place, right? So in the absence of having something to limit that, you'd generally be able to take those distributions, whether it's operating income or whether it's from a refinancing. There is this concept of a parallel qualified opportunity fund basis, which would be a limitation on your ability to pull out cash. So stepping back, the policy here was definitely intended to be getting capital into these zones for a long-term holding period, 10 years. It's typically a bit longer than we see for your typical real estate fund or real estate project. So what we expect, again, the rules aren't there yet. What we expect is something similar to what was suggested in the Real Estate Roundtable comment letter, which we participated in, and we agree with this recommendation, that Treasury should create a concept of kind of benchmarking to your original equity in, and to the extent the project increases in value, you could pull all of that cash out, but you would have to retain at least that original value in the project. We think that would be a very reasonable rule that that fulfills the legislative purpose of keeping money in the zone for 10 years. However, there may be additional liberalization. One just comment to mention on that, we've seen a lot of agitation for unlimited ability to pull cash out as long as the project is still there, right? And the economic development that was the whole purpose of the program is still happening. the letter that I mentioned earlier from Congress to Treasury, which is a bit unusual, from Tim Scott and others, had a broad suggestion in there that, and this has been a common theme, that funds should be able to harvest real estate projects and reinvest into other opportunity zone projects within the fund, subject to the caveat that cash not be pulled out. There was some troubling language in there that made it sound like, at least from Congress's perspective, no dollar should be pulled out of qualified opportunity funds. So we're hoping that they clarify what they intended by that, and that Treasury, makes it clear that that's just with respect to the real estate investment that would be harvested and reinvested, that cash would stay in the fund. But we do expect there to be taxpayer favorable, reasonable rules implemented, hopefully in the next guidance package that's released.
Well, thank you very much. We have some more questions. Let me maybe turn this one to Brad. What have you seen around impact metrics regarding the funds active in the market? Are there any particular investors with more synergies for these resiliency-oriented projects in keeping with the goal of investing in underserved communities? Brad?
Graham, could you perhaps rephrase the question? Maybe
I'll jump in if you don't mind, Brad. So I think someone made the point earlier that PACE and the purpose of opportunity zones really align nicely. We've been working with a number of impact funds and impact investors to help them clarify how do you define impact around qualified opportunity zone investments. And we've seen basically 3 broad categories. And environmental impact is really kind of the one where PACE aligns really nicely. And I mean, quite honestly, it's a bit easier to measure that, just with the developments in the industry with LEED certifications, et cetera. So that in some ways is the easiest, social impact objective metric that you can have within a real estate fund. And the other 2 categories are economic impact and social impact. So kind of economic impact, we would describe that more like path of development and that, I mean, it is a great metric to have, and we do think real estate developments can achieve that. It's just slightly controversial because you have concerns in the different communities about gentrification, et cetera. So that one's a little bit harder just from a, perception, public perception, and how specifically you define it perspective. The third category of social impact, which is more like community resilience and jobs. I mean, again, you have to have the right type of real estate project to achieve that metric. So we're seeing funds come to market with, a hybrid of multiple versions of those types of metrics, but we're certainly seeing a lot that do have that environmental impact metric, and that's where we think PACE would align really nicely.
Thank you very much. Appreciate that. We're coming close to our wrap-up time, and I wanted to again reiterate the thank you to each of our participants, to obviously Wolsey and Orla and Brad and Tony. We also wanted to make sure that any questions that you've submitted that we did not get a chance to answer, we will follow up with an answer to you directly. And we will make available, as mentioned earlier, all registrants can receive the slides for download purpose. And we will also have the audio recording distributed to those who have registered. In wrap up, thank you very much. I think that this estimated $100 billion potential investment in opportunity zones provides an outstanding potential for PACE financing and for economic growth and prosperity around what I call the clean economy investments in opportunity zones. Thank you very much for joining us.